Okay, we're going to go ahead and get started. Hello, everyone. Thanks for joining. My name's Chris Pertet from Signet Financial Management. I'll be the host and moderator of today's webinar titled Dividend Strategies for Retirement. Great to see so many people joining, some familiar faces and some new faces as well. And we're going to go ahead and get started. I'm joined today by Steve Tuttle, Chief Investment Strategist and Partner for Signet Financial Management. And together, we're going to take about 20 to 30 minutes to discuss the topics of the webinar. And along the way, you're bound to have questions. It looks like Gary already found the resource to ask those questions, but at any time, feel free to type your questions in the chat, which is located at the bottom of your screen. And at the end of the session, we'll have a question and answer session, and we'll get them all answered. Now, the webinar is being recorded, so after the seminar is finished, you'll receive an email with some key takeaways, as well as a link to the recorded video, which will be posted on our website. So to give you a little bit of background on why we chose the subject of dividends to talk about today, when investors think of income in retirement, they think of fixed income, that portion of their portfolio that generates income, and most likely it's bonds in their portfolio as their source of retirement income. But with interest rates near historic lows, many investors are concerned about sustaining that income. So what we're going to discuss today is how dividend investing using stocks could be a good complement to the other income producing areas of retirement. So without further ado, I'm going to pass it to today's speaker, Steve Tuttle.
Thank you very much, Chris, and thank you everyone for joining us today. Hopefully this is going to be a useful discussion, provide some good information. And perhaps if you aren't already using dividend strategies, it's a good topic to speak to your advisor with Signet Financial. So I'm going to start with a quote from a very famous book written in 1934, Security Analysis, written by Dodd and Graham. They're known as the fathers of value investing. And it says, a successful company is one which can pay dividends and presumably increase the rate as time goes on. And essentially, that's the heart of a dividend strategy. You want to own good companies that have the ability to produce some income in the form of a dividend, but also have the ability to sustain that dividend and hopefully increase it over time. And the reason I bring this up is because many of you who have been clients of ours for some time know that Signet Financial, we've been helping clients generate income for over 2 decades, but we didn't come up with the idea. It has a very long history that goes back, many, many years. So why dividends, and specifically why dividends now? Well, Chris highlighted one aspect, which is traditional sources of income for retirees, savings accounts, bonds, money market accounts, CDs, they're just not producing a lot of income today. So the first reason to consider dividends today is just that, current income. A portfolio of stock dividends can generate attractive income today, particularly when you compare it to things like savings accounts. Another important reason is total return. And by total return, I mean you want your portfolio not only to generate income, but you want it to create some growth potential. And dividend stocks do a nice job of that balancing act. Produce income today, have the ability to grow over time, potentially. Third reason is risk. There's a lot of volatility in the markets today, a lot of uncertainty. A portfolio of dividend stocks historically has been able to weather the ups and downs of the markets in a little smoother path than the broad stock market. And I think it's also safe to say that dividends provide a little bit of peace of mind to know that even if your stock portfolio goes down a little bit when the market's correct, it really helps clients sleep well at night to know that their dividends are still going to be received in their portfolio in the form of income. Third reason is taxes. It's a very popular topic these days. Stock dividends have a major benefit for most investors in that the taxes that you pay on dividend income are generally significantly less than the taxes you pay on regular income. So that's a nice benefit as well. And finally, inflation. Inflation is a concern. The cost of goods seem to be going up, and that may continue. And as a retiree, you want to make sure that your income sources are able to keep pace with the price of with the rate of inflation. And a stock portfolio, unlike fixed income, in which the income that you receive may not be able to adjust, we like to focus on stocks that not only pay current income, but have the ability to raise those dividends over time and presumably keep pace with inflation. So those are all real good reasons why to consider dividends today. So let's talk a little bit about the low yield environment, which I highlighted earlier. And this is a little bit of a complicated chart, but essentially, if you look all the way to the right, you can see that if you had $100,000 invested in a savings account today, you're not going to generate very much income today. In fact, based on national averages, you may only receive $80 a year on your $100,000 investment. And that is significantly less than the rate of inflation.
Hey, Steve, can I ask a question here?
Sure.
Yeah, the chart is a little confusing. So just to be clear, the gray bars are the income that's produced from $100,000 if it was just in the savings account. And what this is showing is every year what that income would be based on the current rates. Is that correct?
That's spot on. And you'll notice that prior to the big blow up in the markets in 2008, cash could generate some income for retirees. But since then, that amount of income has dramatically decreased, and today it's near all-time lows. And the other thing I'll highlight on this chart are the blue dashed lines. That's actually the amount of income that you would want to receive to keep pace with inflation. And what it shows today is you'd want about $3,800 to come from your portfolio just to keep pace with the rate of inflation. And obviously, the main point of this slide is that just investing in safe havens like cash, while it might make you feel good because you can depend on cash, it's going to be largely inadequate to keep pace with inflation.
Good.
So another slide shows and compares the amount of income that you could expect to receive from a savings account or even a 2-year government bond. Those are the two bars to the left. Both are very low. Both are what I would consider inadequate. And over to the right, if you compare them to some indexes composed of dividend stocks, the income is far more attractive potentially than a savings account. So I think that's the heart of what we're discussing today. Another important role that dividends can play in your portfolio as a source of compounding your growth. And so this slide shows that if you systematically own a portfolio of stocks and systematically take those dividends and reinvest them back in your portfolio, historically, and this slide goes back 30 years, that portfolio is going to compound and grow far ahead of a portfolio that doesn't reinvest dividends. So even if you're not withdrawing the dividend income from your portfolio now, maybe you're not retired yet, maybe you still want to accumulate your assets, dividends can still play an important role in your portfolio and help the value of that portfolio grow over time. All right, so there was many different ways to invest, and even within dividend strategies, there's different approaches. Here at Signet, we actually have two main strategies. One dividend strategy seeks to maximize yield. And so we look for higher dividend payers. And right now that portfolio yields around 4%. We also have another approach, also with dividend stocks, but here we focus on the ability of these stocks to grow their dividends over time. So the yield is a little bit lower, but you potentially have more growth in the horizon. So how do you decide which portfolio is right for you? Now, Chris, I know you speak with a lot of your clients on this very topic. So if you could just take a moment just to go over what those discussions might look like and what are the considerations that you speak with clients about to determine if dividends are right for them.
Sure. Like Steve was saying, like the title says, it's understanding the desired outcome. I mean, really, the key is to figuring out if a dividend strategy is appropriate or will even work for the individual investor. And there are a couple key factors to consider, and Steve already hit on two of them. The first one are income needs. So, how much money do you need, and what are your income sources in retirement? I mean, besides Social Security, which almost all clients have, many clients have other sources of income, such as a pension or real estate income or what have you. But after you total all those up, how much is left that you're going to be needing from your investment account? I mean, the goal here is to not deplete principal, right? I mean, ideally, we want the income to come from bond yield or dividend yield to leave that principal intact, which kind of leads us to the next one, which is growth potential. So there may be times when yield and dividends aren't quite enough, and the investor will need to draw from their principal. I mean, if that's the case, then having a portfolio that only yields income is not enough. There needs to be growth potential in the account, or it risks being depleted. So with growth potential comes risk. So that has to be balanced with the third thing, which is your risk tolerance. So reaching for too much growth can cause your portfolio to assume more risk than you're willing or able to take. So really what we look to do is we look to balance all of those things. It's a lot to balance, but that's why many people hire a financial advisor in the first place, a professional who knows how to balance all three of these and properly construct a portfolio using the benefit of experience and having done it for hundreds or thousands of other clients, and to make sure that your income needs are met, but still keeping the needed growth in the portfolio and not overstepping how much risk that you're exposed to. So that kind of brings to close to the end of our presentation. Before we go to the poll, Steve, is there anything you wanted to add on any of these past two slides?
No, you highlighted it all. I think Q&A would be great right now. I'll just reiterate dividends. One of the main drivers for dividends and why they're particularly attractive today is because it creates that balance. There's the opportunity for income, there's the opportunity for growth, and there's also the opportunity to manage risk, because historically dividend strategies have been able to weather the ups and downs of the market in a little bit of a smoother path than just investing in stocks alone.
Great, well said. Okay, so before we start with the Q&A session, what we'd like to do is we're always interested in hearing from you. So we have a few questions that we'd like to ask as it relates to you and your needs. So Samir, if you could start the poll, and if everyone just take a few seconds and answer these questions, it should be very quick. And after those are done, we'll start the Q&A. If you get done with the poll early and you have a question, please feel free to type in the chat your question, and we'll get to as many of them as we can. We already have 3 or 4 that we need to answer.
So do you have a question, Chris? What's the first question?
Oh, you want to dive right in? Okay, sure, we can do that. Well, we have a couple of them here. Let's start with this one. So this person asks, if inflation and interest rates go up, is that bad for dividend strategies? How does it affect it?
So you start with a tough one. That's a great question, and it's valid. When you have a fixed income from a bond and inflation goes up, presumably that could be a headwind on the investment. The price could go down as the yield goes up, and there are some dividends, some stocks that are more sensitive to rising interest rates than others. And if you think about utilities, that's a great example. Utilities don't have the ability to grow as quickly and may not be able to increase their dividends with the pace of inflation. But this is where active management plays a very important role, because there are also other sectors of the market that actually benefit from rising inflation and rising rates. If you think about material stocks, energy stocks, and financials, those are all 3 areas where we are still finding high quality dividend paying stocks that should actually benefit from rising rates. And so the short answer is yes, interest rates are a factor that you need to consider when you construct a portfolio of dividend paying stocks. But no, it's not necessarily a negative across the board. There's actually some stocks that benefit from rising interest rates. Great question.
Okay. Well, they don't get any easier. So this next one, you may have to pull out a crystal ball. But if the market pulls back, which like AAA says, it's not if, it's when, right? How does that affect dividend stocks?
Another great question. There's risk in any investment, and dividend paying stocks are no different. There is going to be some volatility. Presumably, we invest in stocks because we think they are a good investment and they will be able to generate a return to justify the risk. But I like dividends specifically because of volatility. And I mentioned it earlier, it really does provide some peace of mind to know that as long as that company is able to stay in business and pay their dividends, every quarter, you're going to have an income stream coming in. So while the stock market may go up, stock market may go down in the near term, that dividend payment is far more reliable. And I like to think of it as a rental income. I mean, if you owned a rental property, if you were a landlord, your main concern is not that the value of your building might be going up or down in the near term. Your main concern is the rent income coming in and is it increasing over time? And I think a dividend stock portfolio, it's important to have that same line of thinking. You shouldn't be as concerned about the small moves up or down in the short term. What you should be most concerned about is that dividend income stream coming in? Is it sustainable? Can it increase over time? And presumably you hold on to that portfolio and you have an expectation that 5 years, 10 years, 20 years from now, the value of that portfolio will also be higher.
Right, good. Okay, we got a couple more questions here. So if stocks, well, not if, can stocks stop paying a dividend? And if so, what are the risks involved with that?
So that also is another risk of investing. So there's volatility, but you point out a very important thing, which stock dividends are not guaranteed. They're not backed by the US government or anything like that. So yes, a company can decide to cut their dividend or reduce their dividend if they need to. And in fact, we saw many companies that had to do that at the start of the pandemic last year. And so this again is why it's very important to not just chase the highest yielding stocks that are out there. You want to apply some thorough research and analysis to the companies. And that's exactly what we do when we construct dividend portfolios for clients. We want a nice balance between companies that are higher quality, that they are probably don't have a lot of debt, and probably have some type of competitive advantage that can help them withstand changes in the economy. And that's what we focus a lot of our attention on with dividend paying stocks. So yes, dividend stocks can be cut, they can be adjusted, but there's many companies out there that we believe offer a very good opportunity to not only pay dividends today, but also to sustain them over the long term. And that's exactly what we look for.
Okay, great. So we got just a couple more questions here. Again, if you have any questions you'd like to ask, please be sure to put them in the chat so we can get them answered. While we go through these last couple of questions, Steve, what I'm going to do is just move these slides to our contact information for anyone who might conceivably need that. So here's a couple more questions. What % of investment portfolio would you recommend in dividend stocks?
That really goes right back to that conversation that you had, Chris, about determining what's right for each client. There's no one size fits all approach when it comes to investing. There's many successful investment strategies that are out there. So what I would say to you about that is that you need to take into account the income that you need, the growth that you need, and your risk tolerance, and have a good conversation with an advisor that you trust about what's appropriate for you. In many cases, a balanced approach that has some assets that are on the safer side, bonds, some assets that are more tilted towards growth, and then a nice strategy of dividend paying stocks, which sort of a hybrid where you're seeking some income and some growth.
Okay, good. Well answered. Okay, I'm reading these word for word, just so you know. Besides dividend stocks, do you guys generate yield from other asset classes like options?
We have a lot of different approaches to generate income, and in a low yield environment, there's opportunity to add value and potentially increase income from things like option strategies, from real estate investment trusts, from master limited partnerships. There's a range of strategies that we employ to help clients. Each one of these strategies has their own set of risks, so they may not be appropriate for everyone. But if you're interested in what I'll call a multi-asset approach to generating income, that's right in the sweet spot of what we do. And so the short answer is yes, we do believe it's important and possible to generate multiple sources of income from your portfolio. It takes some expertise, and again, it also takes a good understanding of the risks inherent with each of the strategies.
I'm going to tag on to that a little bit, Steve. You mentioned a word that I use with clients all the time, sweet spot. I like to think that our firm in general is in a sweet spot, that we're large enough that we have the resources and tools available to us to do our own independent research and make very informed decisions, but we're still small enough that we can give a customized approach to clients' portfolios and create that asset class diversity and that different strategy diversity that a lot of other advisors can't. So I like to think that sweet spot is a big advantage that we have over other advisor firms like ours. So okay, now this next one is a statement, but I'll turn it into a question. The statement is in current market, Kramer always cautions against dividend greater than 5 to 8%. To throw the red flag, as it may not be maintained for too long. So I guess the question is, do you feel do you agree with Kramer? Do you think that that's a true statement?
What I'll say is that we look at a variety of factors when we make any investment selection, and dividend strategies are no different. You don't want to only look at the highest dividend paying stocks. And there are some investment strategies, some indexes that are based on that very principle. The problem is that Kramer is highlighting is that some companies that pay high dividends, they're paying high dividends because their stock has gone down so far. And so there might be some inherent risk that's not worth the risk to try to achieve that high yield. So we look at income paid currently, we look at the company's profitability, we look at its volatility and its safety, we look at the quality of that stock, and we across all those factors, we construct portfolios that provide a nice balance between risk and reward, between growth and income, and that's how we think you can best take advantage of dividend strategies.
Okay. Well, great. Well, that wraps up the questions. Is there anything you'd like to add, Steve, before we finish up?
No, I'd just like to thank everyone for joining us. Obviously, one of the things we highlighted is that the decision to invest in dividends is a very personal decision, just like how you invest the rest of your portfolio. And so the next steps, if you're interested, if you're not currently invested in one of our dividend strategies and you want to learn more, is to reach out to us. I mean, you can contact me directly, you can contact Chris or your regular advisor here at Signet. We'd be happy to discuss the strategies with you.
Well said. And that wraps up our session, everyone. I appreciate everyone's attendance today. Please look for an email from us with today's key takeaways and a link to the recorded video. And we regularly do these webinars, so stay tuned for future webinars that you may want to attend. If you have any further questions, like Steve said, our contact information is on the screen. Please feel free to reach out to either one of us or your financial advisor. And thank you once again, and I hope everyone has a great rest of their day.